My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people make friends, just trying to make you some money. My job is not just to entertain, but to educate, teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Beware of hating what you wish for. All my career, I've seen moments like these. Moments where everything that stirred fear on the way up stirs even more fear on the way down. And yet the latter fear ultimately proves to be wrong. Just look at what happened today, where we opened very weak, before the Dow ultimately closed down just 129 points. S&P advanced 0.16%. Most impressively, NASDAQ gained 1.75%, even though it was real ugly at the opening. Let me give you some specific examples of how wrong it is to fear the same thing that you were once hoping for. This is not a heads I win, tails you lose game. The most obvious is what's happening in the bond market. As interest rates soared, with the 10-year Treasury jumping all the way to 3.49, we worried that this would tamp down business investment and make stocks in general less attractive. Worst of all, we were told it meant the economy was heading into a recession, and that was bad. Now the 10-year has fallen to 2.8%. What do we hear? More fear. The same story. It means we're going into recession. Apparently, it's a nightmare that rates go up or down. That's nonsense. You can't have it both ways. You can't be scared of higher rates and lower rates. History says we should like lower interest rates. Stocks with good dividend yields get some lift because they become more attractive in comparison. Businesses will find it cheaper to borrow. Credit's easier. And, of course, it's a sign that the Fed is winning its war against inflation after a couple of aggressive rate hikes. That's good news, not bad news. Don't be afraid to say that. Remember when we were worried about commodity inflation? Every commodity seemed to be soaring. Now they're collapsing. Just look at some of these stocks. Freeport, the giant copper miner, traded at $51.99 in March. Now it's at $27. Alcoa, aluminum kingpin, plunged from 98 to 42. Tech Resources, really a proxy for mining, fallen from 45.90 to 28. Less than a month. These are full-scale crashes, people. Lumber, nickel, corn, silver, all been crushed. Almost all commodities have reversed direction. Today, finally, they got to the oil companies. Today, oil broke down under $100 after being above 120 just a few weeks ago. There was a Citi guy just before us saying that a crash is imminent right in our face. Now, I understand that President Biden's angry that the price at the pump hasn't come down to, but it's only a matter of time. That said, we don't have enough competitive refining companies because politicians have relentlessly added laws that make them impossible to build. Nobody wants a refinery in their backyard. Still, gasoline is ultimately going to come down. I bring this up, though, because we fretted over every dollar as oil climbed to 120. And yet now we're fretting over every dollar on the way down? Again, you cannot have it both ways. Cheaper gasoline is good for nearly everybody because it's a tax on the system. Of course, I don't think oil's going back to $60 or $70 a barrel. The stocks don't reflect that. I'd be a buyer to this total collapse in value. As cryptocurrencies rose, we were told they were stores of value against inflation. But the relentlessness of the rally began to scare us, and we started to wonder whether the whole thing was one giant craze that had sucked in a huge amount of retail value. People began to rant about how overvalued anything crypto was, and then as stocks fell, these things fell much harder. They turned out to be not to be storeholders of anything. The asset class has now lost two-thirds of its value. Again, if you dislike rampant speculation, then the collapse of crypto is good news. Maybe bringing money back to stocks. You can't mope about how these things were surging and be just as bummed now as they're falling through the floor. We need signs that this mania has run its course, and that's exactly what they're giving us. Can't have it both ways. Most important, let's talk stocks. For the longest time, we had stocks romping and romping with new ones invited to the party regularly. Last year, we had literally hundreds of initial public offerings and SPACs that didn't deserve to be publicly traded, raising billions of our hard-earned dollars. Now, if you look at these stocks, you'll see many of them have obliterated, causing the IPO door to slam shut and the back door of the SPAC shut even harder. The idea that we could have zero IPOs, though, is positive. Positive for existing stocks, because institutions don't have to sell their old stocks to take in new merchandise. As the IPO track went along last year, the most speculative garbage companies got through the chute. Yet now people whine that the lack of deals is a bad sign. Give me a break. Plus, the supply of equities does drive up when companies buy back stock. It's positive, not negative. Finally, how are individual companies doing? All I can tell you is that the price-to-earnings multiples have been smashed just smashed on the way down. And it's because of the Fed, not the companies themselves. There simply haven't been that many downside surprises. The strong dollar will hurt earnings as it translates into weaker results for companies that do lots of business overseas. But a strong dollar is inherently deflationary, a sure sign again that the Fed is winning. Everyone hates the Fed so much they refuse to ever think that Jay Powell could be winning. I expect companies will report good, not great earnings. I expect their outlooks to be mixed to negative. But the question will then be, did the stock reflect that disappointment going in? Well, we had the poster child this week, Micron. Micron's a good chip maker with a lot of exposure to the personal computer and cell phone markets and a little less to the Internet of Things, artificial intelligence, and autos, which are still very strong. The future for PCs and phones is dim because in many cases, the consumers already bought their personal computer or handset. They over-earned during COVID. And that's why the stock sold at very low, 5 times earnings multiple right before it disappointed when it reported last week. Initially, after it reported, Micron stock dropped a couple of points. Not more, I think, because it had already fallen from 98 to 55. But it didn't drop nearly as much as you would have thought, given that disappointing outlook. Then we interviewed CEO Sanjay Mehrotra this morning on Squawk on the Street, and he pointed out some positives that really weren't emphasized at all in the conference call, including, most importantly, that he felt Micron will experience nowhere near the kind of decline in earnings that it's seen in previous downturns. They're going to cut CapEx. They recognize that they've shifted much more to enterprise and less to consumer. Now, what happened? The stock rallied immediately. It rallied back to where it was before the negative guidance, and then the darn thing finishes the day up $3. That move actually helped ignite a rally throughout the entire semi and technology group, one that might have some legs if just the analysts let it happen by shutting up and not cutting price targets. On the one hand, we think stocks might be too expensive. On the other hand, the ones that have already come down substantially can now bounce on bad news. That's what Micron showed you, a classic bad news bounce. There are so many stocks like Micron, stocks that are so low, they just might not go down when we hear negative forecasts. Again, you cannot have it both ways, people. You can't think stocks are both expensive and cheap. They're either one or the other, which is why I think Micron jump today is the real thing. It got cheap. So should we hate this market or learn to love it? Wrong question. Perhaps what we should like the stocks that now sell at historically even record-breaking low valuations and recognize that the declines have gotten too great versus the underlying fundamentals, like we just saw with Micron, given the fact that interest rates are coming down, not up. The bottom line, we could bounce around here doing nothing, digesting the declines, but we can't act like there have been no declines and stocks haven't gotten cheaper. In fact, with the collapse of the oils, there's no group left that hasn't been savaged. That may be enough to justify thinking more positively about this entire now-despised asset class, too. Funny thing about stocks, they do still get cheaper as they go lower, provided there's some quality to their business. Sal in New York. Sal.
Hi, Jim.
Hey, Sal.
Hey, I had a question about Roku. It's one of my favorite stocks. Been in it for several years now. Rode it all the way up to 490, and now we're sitting under 100. Lost about 80% on it. What's your feelings about that short term and long term? I feel it's a great play in the space, and
well, I think it can bounce because it's worth more than $12 billion. But I also think that you're up against the Amazons of the world now, and I think that Roku ultimately over-earned during the time of COVID. And so now it's going to have to pay the price. Let's go to Umesh in New Jersey. Umesh.
Big booyah from East Brunswick, New Jersey, Jim. Thanks
now you're talking.
Me.
What's up?
What's up? Ford Motor Company. They're toying with my emotions. Sales, demand, earnings, innovations for their electronic vehicles are all looking picture perfect or almost picture perfect. Strength line has been deviating against the S&P. And as you know, there are recent reports that by 2030, we're going to have a huge shortage in public and private charging stations. How do you see Ford playing out?
Okay, I think Ford stock, we sold a huge amount for our travel trust, and we are itching to buy it back. Why? Because we think, I'm in disbelief that it could yield 3.5%, that it's getting out of every single one of its cars or trucks that doesn't make any money, and it has a very good e-business that's going to be even better when they start rolling out the Lightning Ford 150. So I think at 10-11, I think this stock feels like Micron did coming into today's session. All right, now that oil's collapsed, there's no group left that hasn't been savaged. I like that. I think that could be enough to justify thinking more positively about stocks as a whole. don't go nuts, but think about it. They've come down a lot. Well, Mad Money tonight, the first half of the year is in the books, so when it comes to Dow, which stocks prevailed and which ones would falter? Hey, how about a dogs of the Dow outlook? I think it could work. Then, I was planning on discussing the top 5 and bottom 5 of the S&P 500, but most of the stocks were oils that were winners. So what I'll do is I'll take a closer look at the oil space now that it's going into a bear market of incredible proportions. And then NASDAQ had a tough first half, so I'm dissecting the winners and losers to see what was surprising and what continued to the second half. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.